So what is FAPI? That's the purpose of this slide, is to talk a little bit about foreign accrued property income, FAPI. I mentioned to you that if you have a U.S. corporation that you're investing through and you control it, then it's a controlled foreign affiliate, and you have to recognize income in your Canadian income tax computation on an accrual basis. So you don't get to wait until a dividend is received from your your U.S. corporation. So what is FAPI? It includes income from property, so that's your interest, dividends, royalty, that type of income. Income from businesses other than an active business, and I'll get to that in a moment. And certain taxable capital gains. In other words, capital gains from property that is not an active business income, that does not generate active business income. The meaning of income from property for FAPI purposes is broader than you would think in terms of common law. It's not just interest, dividends, rents, and royalties. For FAPI purposes, income from property is deemed to include income from an investment business. So think of a real estate development business or real estate leasing business. That type of business could be caught. There is an exception, like any good definition will have an exception, and I'll get to that in a moment. Actually, I'll get to it right now. If you have greater than 5 full-time employees throughout the year, then that business would be exempted from the definition of investment business. And that opens up an interesting question as to, well, real estate companies often invest in the U.S. through a multitude of companies for commercial or legal reasons. Maybe they want to avoid having one risky asset taint a group of assets. So they will put all their employees in one entity, and it could be for payroll purposes, just easier to run your payroll. And then the other companies own one real estate property. And maybe the company with all the employees charges a fee over to the development company that owns the risky property. And the question is, well, so does that mean that any income generated by the company with no employees is going to be FAPI, even though you have all these other employees down in the U.S.? And there is a deeming rule that will allow recharacterization of what would otherwise be FAPI income to be active business income, 95(2)(a)(I). So FAPI is included. This is another reason why FAPI is important as a concept. It's included in surplus accounts. There's what's known as taxable surplus, which is basically active business income that doesn't come from a treaty country, and passive income. And then there's exempt surplus, which is active business income from a treaty country. And the importance of exempt surplus is that if you have a foreign affiliate that generates active business income, you can bring that income back tax-free by way of dividend to Canada. There's no Canadian tax. You get a full deduction against that income. The taxable surplus account, there is a formula whereby you get a deduction based on the amount in your taxable surplus account. And there's a further account that's called pre-acquisition surplus. And basically, you can extract money out of that account as well, but it grinds the cost base of your foreign affiliate. And pre-acquisition surplus, think of it as basically a return of capital account.
But once you've exhausted all your levels of surplus, exempt, taxable, and you have nothing left, and you continue to pay dividends, everything is considered to be pre-acquisition surplus dividend. And it just completely grinds on the basis of your shares. The concept being that in theory, your cumulative surplus must have been your cumulative earnings over the years, and to the extent you've paid them all out, the next payment you should be likely returning your initial capital, and that's the concept. So pre-acquisition surplus isn't really a bucket; it's just kind of a default. That's where it all goes until you exhaust basis, and then you go negative, and it creates a capital gain.
And one important point to remember is that when you have a controlled foreign affiliate that's earning FAPI, as I mentioned, you have to accrue that income whether or not it's distributed in your Canadian income tax computation, but you get a deduction for foreign accrued tax. And if your U.S. tax rate is higher than your Canadian tax rate, generally that, what we call a FAT deduction, foreign accrued tax, wipes out any Canadian tax liability that you might have otherwise had. The FAT deduction is really like a proxy for a foreign tax credit. So a foreign tax credit, if you invested directly in U.S. real estate, you would get to claim a foreign tax credit on in respect of the U.S. taxes that you pay on that U.S. income. But if you operate or invest through a U.S. corporation, then you don't get the foreign tax credit. Instead, you get this the FAT deduction that I'm talking about. And then you're into the surplus system where you get potentially dividends out of exempt surplus, taxable surplus, or pre-acquisition surplus. So going back to my earlier comment about the greater than 5 full-time employees throughout the year test and what relieving or rule there is to allow a Canadian investor to invest in a practical way in the U.S. and mitigate their risk by setting up various corporations to hold their U.S. real estate. That's the provision in the Canadian tax law that deals with that recharacterization rule, deeming what would otherwise be passive income to be active business income. And yeah, so there's actually a diagram on the next page to show you what I was trying to explain earlier about where you have a Canadian parent company that owns 2 subsidiaries, and all the employees are in what we call the mothership, FA1, that carries on an active real estate development business. It's got employees, and they're actively managing that business. And it provides management services to FA2, which holds a single real estate development property. But it's a risky one, so it doesn't have any employees and it doesn't have any other properties. And that income, when that FA2 sells the property, is going to be recharacterized as active business income.